All right, guys, target rate probability. Go on the CME group. They have a great FOMC next meeting, and they have charts and they have probabilities. Check this chart out. This is for the September 18th meeting, 2019. What we have here is, don't wait for the cut to happen to play gold. Oh, they just cut. It's confirmed. Gold's going to go. It's going to skyrocket. This has brought to my eye visually. I hadn't seen before. Remember, they say, oh, the market's a discount mechanism and market takes events and prices that in. Well, until I saw that chart, I think I've never seen really an event how it was actually priced in. These are the probabilities. So for the September 18th meeting, to get that 175, 200 target rate, look at the chart. Here we're below 20% right here. A nice little TA line. Oh, broke out. Late May, we had a breakout. Off it went. Probabilities go up. Okay. Need more guidance. Sideways move. Trend line. Late July, breakout. Goes up. In two separate occasions, there was a breakout in the probabilities of a target rate actually going down or going to another rate. Now look at the gold chart right here. Same date, late May, when the rate cut probabilities go from 30 to 60, gold moved instantaneously. Even had the same type of sideways pattern, guys, that we saw as the probabilities, right? It was going lower and then bam, goes up. Gold moves, starts to price it in. This is the market. You're actually seeing the market discount pricing in a future event. Because the rate cut, when it happens, we're already for many weeks we've been moving sideways. It took this period here to fully price in that probability of that cut. Increasing. We're not even in the cut yet. We went to 60%, right? Sideways move. When the price cut probabilities increased again from 60 to 95, when they broke out the price of gold, same time it broke out. And then you see again, markets discounting until we start topping out here. And now the market has fully priced in the probabilities of the rate cuts happening. Not the rate cuts himself, just the probabilities of those rate cuts happening. So that's how the price movement of gold is actually moving in harmony with the rate cuts probabilities breaking out themselves. This is very enlightening for me. When I realized this, I said, wow, what? Again, now you could say the chicken and the egg. Is it the rate cuts breaking out that's making gold break out? Is it gold breaking out that's making the rate cuts break out? Or right now I'm on the sideline about that, and I'm thinking more maybe they're both breaking out at the same time because they're both reacting to the same underlying macro driver. I'm not sure what it is. Is it a confidence in central banks? Is it all that money printing? Is it whatever? But they both seem to be reacting to the same thing. It could be one driving the other. Maybe I'd favor something driving the rate cuts, and then the rate cuts actually gold sniffing out that there's going to be a rate cut. And the common theme is lower interest rates on the US dollar. Then it's more attractive to hold gold than hold bonds. Here is my final scenario based on my observations that rate cut probabilities breaking out or driving the price of gold. Right here, we had rate probabilities, or the actual target rate actually topping at 250. Price of gold, was it due? Sidelines, drifting slowly sideways until it starts sniffing out that maybe we're going to start cutting. So we're not doing a lower low here. And after that break, bam, we break right here with that breakout on the breakout on the rate probabilities went from 20 to 60%. Gold breaks out right here. 25 days, 11.5% increase in the price of gold. Sideways drift. Here's a rate drop that was being priced in. But as soon as that one was priced in, the market has already starting consolidating the rate cut probabilities of breaking out. And as soon as that rate drop happened, the market already started pricing in the next two cuts. Oh, that's those next two cuts, they're worth 8.6%. That was done in about 34 days. All right, that's it. Market now has been drifting. Here's the cut that happened that was priced in. Here's the other cut that was priced in. Sideways drift. Total. So for those three cuts, 75 basis points divided by 3, 20% divided by 3, 6.7%. So let's say 7% increase for 25 basis points cut. I like doing that. Try to get a unit, and after that, that's when it comes fun, because you want to manage your expectations. You want to see if the rate cuts are the drivers for price of gold, and only that and nothing else, not the money printing, not whatever, just that. How could that impact the price of gold? Well, we're having the same type here. It's slow drift, right? Because we had no guidance until we got closer here. Slow drift. We have no guidance here, right? Because after this date, remember, we market probably started realizing that we're only going to get 2, and in December we have 0 chances of having a rate cut. You could go check on the CME website, 0 chance of having a rate cut right here. But I think in January it's picking up 13%, and in February or March, the March meeting, I think we're at 30%. So the odds are already starting to increase a little further on. So I think we're gonna drift some more. Maybe this type of pattern hit the trend line once more, go back down, but not lower. We're going to do a higher low, just like we did here, higher low. And we're going to have the same type of situation where the probabilities of a rate cut are going to break out again, and gold's going to break out at the same time. And then we're going to, I don't know how many rate cuts we're going to get. I'm imagining, let's say I get 3 rate cuts, 7% each off the break line right here. I'm imagining that those next 3 rate cuts are going to bring us to push gold above 1800. Could take that a step further to bring us down to 0. So let's say we go down to 0 rates. That's 7 more cuts. 7 cuts times 7, 49%. From here, I believe 49% brings us about 2150. So that's how I'm imagining the price of gold being affected by rate cuts. The probabilities of having those rate cuts, right? Because the market, as you saw on the previous chart, was actually pricing them in before the actual cut was actually here, right? And look, the price action already started moving up as we went from 20 to 60%. And after that, when we went from 60 to 90% of having those rate cuts, everything was getting priced in ahead of time. Typical by the rumor, sell the news. And right now, if you were buying at these occasions here after the rate cut saying gold was going to explode, now you're going to get discouraged. You're going to say, hey, that's not working out. But the way you should see it is now the reservoir of fuel is full. Nobody's expecting rate cuts. We're this type of situation right here, but at a higher plateau. Rate cuts now, they're going to start building up. They're going to start building up to have more and more chances of having rate cuts. And after that, we're just going to explode right here. So this is actually when most people fear, when most people gave up on gold and say that's not working, the rates are low, it's not going up. It's when the market starts pricing in the next rate cuts that this is actually going to explode, guys. All right. Hope you appreciate that. For me, that was very revelating, and see you guys soon. Ciao, guys.